Good afternoon. I'm joined today by Chief Market Strategist at Purpose and my outsourced Chief Investment Officer, Craig Basinger. With 25 years of experience, he and his team manage over $1 billion in assets in dividend and quantitative risk reduction strategies. And he joins us today to provide some market insight and to speak to our expectations for the fall. Craig, markets have been pretty ugly year to date, and the talk is that a recession is on the horizon. People are worried that there's more downside to come. Can you speak to that? And can you speak a little bit to the fact that bear markets usually precede a recession?
Yeah, absolutely, I would agree. This year clearly has been challenging. Challenging on the equity side of the ledger. It's been challenging on the bond side of the ledger. It's been challenging pretty much across the board. We've got inflation. We've got central banks. We've got, had a really hot economy, which is now slowing. We obviously war. The list goes on. I could keep piling it on, but thankfully I don't work for the media, so I don't have to just talk about the bad news side. But I also think it's worth taking a step back, and really what I think we're going through is a bit of a repricing of assets, and that's why it's sort of percolated across different asset classes all at the same time, which is tough for portfolios, 100%. But it's also worth noting, portfolios did really well for the previous 18 months heading up to this. In fact, when I say really well, probably better than normal. So I think a part of this is giving that back. But you're right. The big question now is, is there a recession looming? I can certainly say we are not in a recession now, because if you try and book a hotel room in Toronto, it will cost you, I think, $600 downtown. All right, maybe tips going on, and Elton John just played last night, but still, this is not recessionary kind of behavior. So even though we've got some weird things going on, it's a little premature to sort of sound the alarm bells on the recession side. But I'm just going to share a few slides, and I'm just going to jump around a little bit here. But I think there's, one of our slides really, I think, helps encapsulate, what's going on, both in the markets and the economy.
And maybe you can discuss sort of the separation between market versus economy, because I think a lot of people intertwine those two.
Yeah, no, they're at the extremes, they connect, but in between then and there, it's they both move on their own independent paths. This is just our disclaimer. You can pause and read it at your leisure. But yeah, if you take a step back, we obviously, I'm not going to go into the pandemic, but we've gone through this environment where a lot of our behaviors changed. We all, we work from home a little bit more. We stopped traveling as much. We stopped eating out as much. And again, that's starting to change back. But when we were going through that, because of sort of, let's call it pandemic-induced behaviors, we really changed our spending patterns. And now this is US data, so I do apologize. It looks very similar in Canada. It's just probably in millions instead of billions. All right, maybe it's billions here too. It's just not as many. But this chart on the left is spending on goods, like actual stuff. And as you can see, it trends up pretty steadily as the economy grows normally. That little blip there where it jogs down, then continues up. That was the 2008 recession. So, that's sort of what happens in a normal recession. And then it gets back to normal and people go back to buying cars and iPads and whatever else they want. And then we have this crazy line that did what it did at the end of that. And that really is because we stopped spending on other stuff and started spending on goods. And that is fantastic. And it is not fantastic at the same time. It's fantastic because it supercharged corporate earnings. The fact is, if when I'm in Ottawa in a few weeks, if we go out and have a pint of beer or a glass of wine, it's good for the economy, but it is much better for the economy if we just, when we got together, each of us went out and bought a new iPhone, even if we spent the same dollar amount on our endeavors. And that's just because there's so much more of a multiplier, so many other industries impacted, and it impacts the stock market much more than having a beverage. So our changes in behavior supercharged earnings. At the same time, there was piles of stimulus put into the system. Interest rates were low. So you had super earnings. You had a super economy. This is coming out of the pandemic, obviously. the economy recovered really fast and even overshot where it was before, and the markets flew. That's short version of what was going on. Of course, we were all fretting about COVID at the same time, but that's what was going on in the background. Now that's starting to slow down now. And this is where these big waves of, even if all of our behaviors just change 5%, if everybody kind of does it, it causes these ripples to go through the economy that, yes, the economy is dynamic. Yes, it adjusts, but it can't adjust that quickly. And that's, sure, there's China lockdown. Sure, there's logistics problems. Sure, there was, lack of worker problems in certain areas. But that is really what has driven so many shortages. Now, those are starting to be addressed now because stuff catches up. But now we're flipping to services. People are starting to spend less on stuff and more on services. And there's this revenge travel thing going on right now, which is we've all been sitting at home for too long and we're all rushing to get out. And this is then causing a further sort of another reverberation through the economy. So while this first one on the good side is slowing down, the services side is picking up and it's now back above pre-COVID levels. And why that's important is because it was absent for sort of 18 months or 2 years to a certain degree, absent or certainly depressed. And when that happens in the service industries, they just cut back on capacity. In other words, we have fewer hotel rooms, we have fewer flights, we have fewer luggage handlers. And they can't employ those people hoping the demand will come back because that's the shortest distance to go bankrupt for any corporation. So they actually have to wait till the demand comes back. But then, of course, demand comes back really quickly and we run into the same boat. Now, hotel prices are too expensive. And yes, your luggage gets lost more because they're gradually catching up on the capacity side. But what I'm going into here is really almost everything from inflation, the really high stock market, to now the response of central banks pulling back on stimulus, and even a potential recession ahead can be explained by these massive changes of behaviors that we've gone through. And we could have a recession ahead. It's quite possible. Even if good spending normalized. Now, is it going to normalize and get back on its normal path? Or is it going to normalize and come back down? Because, if I bought a recreational vehicle last year, I probably don't need another one this year. So they're called goods for a reason. They last longer. So potentially that's going to be a big headwind for the economy. But will it be a traditional recession? That I don't know, because at the same time, we're still short-staffed across the board. So we could actually have slowing economic growth with reasonable employment, which is just, I've studied as an economist, this would be a brand new textbook for sure. So, I just think, and the market's reacting a similar way. So I think what we've gone through is we sort of goosed asset prices higher because of all this good news over the last, year and a half up until the beginning of this year. And now we're sort of giving some of that back on the repricing. Could there be a recession ahead? Absolutely. I think it's still a bit early to sort of run out and sound too many alarm bells on that side.
So I guess the concern, though, is recession sounds bad. What does that mean for markets? Or is there more downside to come in markets if we're waiting for a recession?
Yeah, it depends. I would say the froth has certainly been taken out of the market in the first 5 months of this year, and that was taken out of the bond market, taken out of the stock market or the equity markets, depending on what you want to call them. And it's gradually coming out of the real estate market too. The price mechanism in the real estate doesn't react quite as quickly. So I think that has been kind of a repricing. Now the big question comes down to, are earnings going to start to soften? And earnings expectations are still way too high. So I think that's sort of a headwind that we're going to run through in the quarters ahead. And on the economic front, things are slowing down. Now they're slowing down a lot more globally. But they are starting to slow down even in North America. Canada, we just had our third, poor jobs print in a row. And largely, a big negative contributor was construction jobs. And a lot of, that has, for the past 20 years, I mean, not every month, but for the past 20 years, that has been a steady, incremental, positive influence on employment in Canada. And now, topping out in one down month doesn't say a trend has started, but we all know that housing's under a lot of pressure now because of higher financing costs and interest rates. So, it's interesting to see how this manifests. Now, there are bigger negatives internationally, which I'll just flip forward to this guy here. I mean, China is in a, in 2008, China kind of saved the global economy. I mean, everybody speaks ill of China for a number of reasons. We won't get into that side of things, but say what you will. In 2008, they literally saved the global economy by stimulating when everybody else was sort of shuddering in, and they did that again, sort of in 2018 and a little bit in 2015. So, in the past like 10, 15 years, the China growth engine has sort of come to save the global economy during periods of weakness. And right now, that just does not look very promising. There's the COVID lockdown for one aspect, but they do have a real estate problem. This chart here is real estate developers in China, whether listed in China or Hong Kong. And this is our sort of canary. Like, if this keeps going down, it's just this will turn up before the actual real estate starts to improve. And that's a bigger part of their economy than real estate is for our economy. So it's a big deal. And not saying nothing's going to implode. I wouldn't say that. It's pretty centralized government, but as far as like lifting global growth, I just don't think they're going to be there anytime soon. And then we have Europe, and everybody sort of is well attuned into the European issue. They do have inflation similar to the rest of the world, but at the same time, they have an energy crisis and slowing economy. And this is just the economic growth forecast consensus for the next couple of quarters, 2023, 2024, what it was 6 months ago and what it is today. And that is a material and rapid decline in forecasts. I don't think that stops at zero. Like, those things will shoot through because consensus is pretty slow moving anyway, so it's already probably behind the curve. So we've got these sort of big pieces of the global economy that just are not looking good, and that certainly isn't good for global growth. Now, there is one huge positive, and when I say huge, they are huge. It's the U.S. consumer. The U.S. economy is obviously the biggest in the world. The U.S. consumer actually represents, consumer spending in America represents a fifth of the global economy. So it might be unfortunate what's happening here in Canada, and we'll fret about it because we live here. But in the big scheme of things, we're not much of maybe not a nothing burger, but pretty close to it. The U.S. consumer is obviously the big driver, and the U.S. consumer is actually in good shape. They're less levered, especially compared to us. They've added 3.5 million new jobs so far this year. Their average weekly hours plus their average hourly wage, you get up to like $203 billion of incremental income going into the system this year. That moves the economy. That is a positive. So again, like, there's these weak spots, but there are some pretty positive ones as well. So I don't know if a global recession is imminent or in 2023. It is increasingly a risk, though.
So I know in your portfolios you've raised some cash by selling off some U.S. equities. Why U.S. equities if you feel like they're the good news story?
Yeah, no, good question. So, and again, that comes back to your original point. There's the stock market, and then there's the economy, and they are somewhat connected because the economic growth invariably drives corporate profits, which invariably drives the stock market. But there's a few other moving parts in there. And, what really led us to, wanting to dial back, we viewed the rally that we saw that started in June up until mid-August as what we would call sort of a bear market rally. In other words, not something that's going to be overly sustainable. It's obviously proving me wrong today at the moment. But, we looked at that and said, what, we want to dial back and take some off the table because, again, the fall is typically a volatile time. And the reason we picked the U.S. actually comes down to this really complicated tables in the middle here. I'll briefly try and explain what we're looking at here, but the U.S. market today is pricing in 15% earnings growth, and
Sorry,
it is.
I don't think you're sharing that table with us.
Oh. Sorry, it's this. Does it say earnings growth in the middle? These two tables here under portfolio construction?
No, we're still seeing event or recession.
Huh. Well, that I can't explain. Let me just try and reshare it. Share. All right. Event or recession? Is that what you see right now?
I'm hoping it's going to show up.
Oh, I see. It's not even. All right.
All right. Maybe you can speak to.
Maybe we will not do the sharing side. Hold on a sec. That's strange. But yeah, let me describe what the table looks like.
Sure.
Yeah, so it really came down to the U.S. market is pricing in about 15% earnings growth, which is reasonable. I mean, we're not saying we don't disbelieve that, but from our perspective, do we think that's going to get better or worse as the next 12 months roll by? And since we think the global economy is slowing down, the U.S. dollar is stronger, we just think that growth is going to slow down a little bit. And at the same time, it is trading 17 times earnings, which, is kind of in line with what their average has been for the past 20 years. Still expensive if you look at a longer time period. And with higher yields, we just think margin expansion or the multiple expansion is going to be more challenging. So we looked at that and said the US market's still priced really well. We look at the Canadian market, for example. I mean, we're pricing at about 10% earnings growth. So we're already expecting lower earnings in Canada. That's what the market's expecting.
Right.
And we're trading at 12 times earnings. So we're actually historically cheap. So we really looked at it and said, you know what, if where we think things are priced too aggressively is the US market, and that's why we want to take some off the table there.
Okay. So what signals are you waiting for to redeploy?
Yeah, I think there's a couple. Like, one, if prices got a lot cheaper, we would change our tune. Like that's, one of the age-old lessons that, it always makes me laugh because everybody people go on TV or talk anywhere and they talk about the growth, the fundamentals, the economy, and it's like really the biggest determinant of your future performance is how much you pay for something. Because your starting point does matter. So if we did have a weakness in the market, we would be redeploying because again, even if we do get a recession, we think it's going to be a pretty mild one just because there aren't that many excesses out there. So price would be one. Again, that wouldn't be a happy place to get to because that means the prices would drop from here. But I would point out, when we dial back US, we mainly added to cash. So we sort of have a bit more dry powder. The other factor is if we started to see improvements on the economic side, if we started to see more improvements out of China, if it did start to show that sort of the energy crisis in Europe was starting to abate, if we did see sort of more of the more forward-looking indicators starting to turn up, but right now they're not in a positive fashion for obviously what we've just sort of talked about. So I think that's what would trigger us to start to reverse and add more market exposure.
Okay. In the remaining time that we have left, can you leave us with a little bit of good news?
Yeah, I think the good news is this is still, we are still in a world that is experiencing sort of the reverberations of the pandemic and pandemic changed behaviors, whether they were changed temporarily or permanently. We'll leave that up to the historians to tell us after they've done whatever they're going to do. But the important part of that is that even if the markets correct more, or even if the economy slips more and then starts to recover, like these are all just sort of the gyrations that we kind of have to go through because of what we went through before. And none of them are very nefarious. In other words, there's no excesses built up in any part of the economy. There's no mark-to-market cascading like systematic risk. I mean, that we can see anywhere. So, while not overly positive, the downside we don't think is hugely material, and I think it's going to be tradable to be a bit more opportunistic around the edges. But again, the sort of the dire outcome just doesn't seem to be there. This is more, we're still going through the adjustment phase of what we had gone through. And I'd also point out those sort of reverberations or waves, if you want to call them, going through the economy, going through the markets, they are starting to get smaller. Like bonds, nobody likes their bonds anymore because they've gone down in price, and they rarely go down in price. But one of the neat things about bonds is every time they go down in price, their actual future return starts to get better. So now all of a sudden things yield more again. Like it's a healthier yield. It's a healthier starting point. And yeah, it was a pain in the butt, pain in the portfolio to get here. But like the starting points are starting to get much more constructive going forward.
Super. Well, thanks very much, Craig. I hope that your comments provided a little bit of sunshine and hope for people, and we'll talk to you again soon.
Yeah, thanks for having me.
Cheers.